Hi, good evening, everybody. How's everyone doing? Welcome to the first lesson. Hello. Um, yeah, okay. Welcome. Let's just wait another 2 more minutes. So, in case you need to go to the washroom, go to the toilet now, feel free. We'll start in about 2 minutes time. So 7:02. All right? Yeah. Good evening. So we'll start in about 1 minute. Let's just wait for some of the other classmates to join. All right, so let's start. So again, for those who have just joined, welcome to the first lesson of FIN 355, Equity Securities, or basically Equity Valuation. Today is the first lesson, so really excited to bring you through this module. Um, just a quick show of hands, are most of you in your year two or year three, or are there any year ones? Year three, yeah, okay. Okay, so we have year two, year three. Okay. Okay, mostly three. Okay, that's good. So as you know, this module would leverage quite a bit on your prior experience or your prior knowledge on things like time value of money, other things like discounted cash flow. And they are basically all contents or kind of like prior knowledge that was being taught in your year one, year two modules. So of course, given this is a level 3 module, we will need to use some of those knowledge. However, if you do not or you can't remember, do not worry. So currently in our tutorial group, we do have two sets of lecture slides and they relate to your FIN 203. I'll recommend if you kind of feel that you are a bit rusty, feel free to go through those. But yeah, so we will assume that you have those knowledge as much as possible because we are building on the prior knowledge. I'll try my best to go through a little bit of the past, but given the content that we have to cover, if you really feel that you can't recall what was taught previously, encourage you to have a look at the content for recap. Okay, so this semester we have two lecturers, so myself and Chong Wu. So I think this class is quite big. I think we do have close to 40 students, quite a large class. And these are the course objective. We'll go through them bit by bit later, so do not worry. In terms of the course readings, the focus would be on the lectures notes. So while you can reference the textbook or study guide, we'll focus quite heavily on just the lecture notes itself. And for your test, GPA, or even your ECA in the future, you simply just have to focus on your lecture notes. Okay, so unless you require a bit more information, you can refer to study guide and textbook. But other than that, actually, your lecture notes are more than sufficient for your assessment and for you to do well in this course. Actually, I forgot to go introduce myself. and I probably should. So my name is Drew, and I'm from a more of practitioner background. So Chongwu, I believe, is more of an academic background. So for me, I'm more a practitioner background. Started my career in as a credit risk analyst at a corporate investment bank. And a credit risk analyst kind of do equity valuation as well. And in fact, that's the bread and butter of what we do. After that, I moved to being a corporate banker. So I was a corporate banker at Credit Agricole. And if any of y'all have aspirations to go into corporate banking, uh, feel free to reach out. Um, and then after that, I actually moved to Canada. So I was actually in Canada for 2 years. I was partially doing my PhD there, as well as working as well. So I worked as a data analytics modeling analyst. Basically, if those of you all who are from analytics field, you can't build data models out of like large data sets. Nowadays it's quite popular, quite a nice role to be in as well. And then now I'm of course back in Singapore, and I'm back in corporate banking, which is something I enjoy. So I understand that there are also a few accounting students as well in the course. So in case you group up with the accounting students, I'll encourage those that are specializing in finance to guide them accordingly, because this module for accounting students, especially if you do not have a finance background, can be a bit challenging. Just want to quickly ask, how many of you are actually working as well, working full time and doing this degree as a part-time program? Okay, we have a couple, three, four. Oh, okay, we have quite a bit. Okay, quite a few, a fair bit of you guys are actually working. So, given that you have work experience, I think it'll be very useful as well. You might find this course extremely useful, whether is it if you eventually want to land a role in banking, or maybe even for your own investment purpose. Okay. Okay, in terms of the assessments, basically we have three assessments. We have the first assessment, which is TMA. I believe the date has been released. So it'll be on 15th of February. Let me just pull out my pen. So it'll be 15th of February. Um, so this will be 15 slash 2 slash 25 for TMA. The units cover is 1 and 2. So this has been announced in your canvas in the lecture group. We have our GBA as usual, and what I like to usually highlight for class participation. So for me, I like to be very upfront with you. So this is an evening class. Then what this means is that everyone would at least get 50% of your class participation, regardless of whether you come, don't come, because attendance is not compulsory. And even if you don't participate, you get 50%, right? So, the other 50% will purely be on your participation. So whether is it typing, I usually really encourage students in my class to unmute yourself, especially if you have questions that, are a bit more lengthy to type out, right? But either way, if you feel like unmuting yourself and just asking a question, feel free to do so. If not, you can just, right? But at the same time, I just want to highlight, in case for whatever reason, because quite a few of us are also working full time. So for whatever reason, if you can't make it, it's fine as well. You don't need anything, and you still get your class participation of at least 50%. Yeah. Okay. And then at the end we have AECA, which is a take-home assignment for this course. And I will pause for a short while. Any questions for this? Okay. Nope. Clear? Okay. So in terms of the format of the lecture, I usually like to do two breaks. I feel that it's a lot better. I hope that all of you are okay with it. If you feel that two breaks is too much, do let me know. So I usually like to do for every hour we have like a 8 to 10 minute break, and then the second hour we have that as well. So we have two breaks in between to let you kind of refresh a bit, take a small break, and then we continue the morning, right? Okay. Some of y'all have asked about financial calculator. We will not be going through the use of financial calculator in this module. In fact, actually, we will need to heavily rely on Excel, especially for the modeling, or not modeling, but the valuation part of the module. We Financial calculators are simply not enough to do it, right? So I think from lecture two onwards, it'll be good that you have whether your laptop or Excel in front of you so that you can follow the examples. One more thing before I forget, for the GBA grouping, so GBA grouping, please, this one, so please send me your grouping by the end of this lesson, right? So I already saw some of y'all that have sent me the grouping, that's fine. So for those who have not gotten a group, please do so during your breaks. You can, type in the group chat, reach out to each other. So please send it to me via email before the end of this lesson. If not, do not worry. In case you do not know anyone, do not worry as well. You'll just be randomly allocated to a group, right? So if you have a preferred group, do email me your group of 4 students. So group of 4 um, students, and if you for whatever reason do not know anyone, or you are just open to being randomly assigned, do not worry. Um, so I know uh I know you can do that as well, but I prefer not to. So the reason why is that when you do or when I set up like a student um a group that allows students to go in and out, I cannot actually use that grouping to assign grades for your GPA. So only if I create a group myself and do not allow your access to it, then the grouping will be captured in the GPA market. So it's a back end thing, right? So the preference will be really for you to just email me if that's possible. Okay. Hope I answered that question. Okay, so guess we can start. All right. So as I usually like to cover for all modules, right? I'll try to make things very simple. Try to provide you the high level kind of explanation or the idea that you need to understand before we go into the details, right? Because once you go into the details, it gets very complex, and then after a while, maybe you lose track of your goal. You lose track of what's the purpose of this doing all this complex calculation, right? So I really like to go um first very high level, right? So at the end of the day, right, what's the purpose of this course? Let's think about it in very simple terms, right? What's the purpose of this course? Throughout the 6 lessons that we're going to cover, the ultimate purpose is for you to, at the end of the day, be able to value a company. So if I give you the financial statement, I give you some information about the industry, can you actually value the company? Right? So yes, so yeah, welcome also. Nice to see you again. I know some of y'all have taken some other lessons as well. So yeah, welcome. So at the end of the day, yes, it's to value a company and to make some money. If you are in case you're an investor, to make some money, right? So that's the purpose of this course. So through the course, right, we are going to go in quite a lot of details on different techniques to value the company, different considerations, right? But at the end of the day, right, it's just to value a company. In fact, if you are going to look through past year assessment, the assessment criteria is always kind of the same. They just ask you to value a company, you need to write a report, etc., etc. Right? So that's the purpose of this course. And so with that in mind, right, whenever you see certain tools that's being provided to you, the question you have to ask yourself is this tool useful? Or is it not useful? If not useful, use another tool. So we'll go through multiple tools to equip you with all the possible tools that you can use, or at least most of the possible tools that you can use to value the company, right? And it's up to your own discretion to say, okay, I'm going to use tool A, I'm going to use tool B, right? So it's really up to you whether which tool you want to use, right? So just put that in the back of your mind. Whenever we go through a framework, we go through a technique. These are just all various tools for you to value the company. And it's up to you whether you think that these tools will be useful in this situation, in this company, in this particular case, right? And if it is, you use the tool. If you don't think it is, maybe you have to justify why you not use the tool, or you can just use a different tool. Okay, and in all cases, since we are in finance, we want to make some money as well, right? That's the purpose of finance, right? Okay, so of all assets, whether it's financial assets or real assets, there is a intrinsic value to the to the asset, right? So the idea behind valuation is to find what's intrinsic value, and from there, maybe if there's a mispricing, we can make some money out of it, right? So they want to identify understand the value and its sources. There are certain key roles in finance, as you can see here, right? Value investing. Yes, that's right. To invest in something that will create you earn some profit and some value. So at the start, I might go a bit fast because all these detail, right? Like what I say, right? What we're trying to equip you with tools, all these are just like background information. So just bring up to date of what we're talking about, but they will definitely not be tested. Um, you know, the assessment will not ask you what is valuation. These are just like background, right? So we might go a bit fast, so do not worry. We'll not go through line by line as well, right? Okay, so what are we trying to do? Basically, valuation, requires certain amount of skill required to value an asset. There's a certain amount of art and science. The science is what we're trying to teach you. The art is from the experience that you have in the industry, right? So it's a mixture of art and science. It's not all just numbers and if you learn this module, you definitely can make a lot of money. Not necessarily, right? Because there's some form of art that is required to identify and value asset, right? Okay. So this is what I'm trying to say. The valuation methodology provide you a range of tools. Um, Remember that it's not an objective exercise, right? So what does this mean? It means that at the end of the day, if you are like you are an analyst that is valuing a company, and your friend is an analyst as well valuing the same company, chances are both of you will not get the same value for the firm if you value them together. And that's because it's not objective exercise. You require some skill, like I mentioned, some science behind it, but it also requires some art. And as you know, what's art? Art is perception. It's about what you think is right, what you think is wrong. And we'll see this in play in one of the case study in Nike, which will be a very important case study that we'll go through in the next lecture. Okay, you'll see how different perception, maybe even biases, uh, uh, can actually play a role in valuing your firm and will result in different valuation. There's some comment that some believe that the pursuit of true value is useless. Uh, Useless to do so. There's some comment. Let's see. So, if you are like a trader, which I believe some of y'all might be into trading, you know that trading follows patterns, right? So you do not really value the firm. You are actually trading based on certain parameters, which we'll talk about as well in lecture, I think five. Yeah, lecture five, right? So when we talk about valuation, right, usually this is more long term. So we are talking about long term kind of investment horizon, right? And this is not trading. So valuation and trading are opposites of the same coin. But valuation, you can think about it as a bit more long-term nature. Reinforce misinformation with crayons. What do you mean by crayons? Ah, yes, the candlestick. Yeah, yeah, crayons. Yes. Yeah, so we'll talk about technical analysis as well. That's a good point to bring up. And we'll draw patterns. You'll see a lot of patterns being drawn, trying to see whether the prices of a stock is going in certain direction. Okay. Okay. So back to valuation. What we are trying to do here at the end of the day, right? Let's just take a very layman example. Is that we're just trying to find what is the intrinsic value or what is the real value, right? What is the intrinsic or what's the real value of an asset? Now, market price is different from intrinsic value, right? That's how you make money. So imagine you have one asset. The market price is 100, but the real value, the intrinsic value is $90. 100 versus 90. If you're going to sell the asset in the market, you're going to earn $100, but you know that it's actually only worth 90. So you actually earn $10. So that's the ideal valuation, right? What we're trying to do is to try to find the intrinsic value here. By finding the intrinsic value, we are able to, whether it make a profit or maybe it's not the right time, we can just hold the asset till the right time, then we can sell it for a profit. So that's the good question. So intrinsic value is not equals to book value. Okay, so book value is basically cost of asset. So if you taken okay, so most of you all have taken accounting, right? Cost of asset minus accumulated depreciation. So AD, I like call it AD, basically accumulated depreciation, right? So book value, what is in the books is your cost minus your accumulated depreciation, and this is book value. Now, market price is the price you get in the market. So this is the market. So if you sell an asset today, how much you can earn, right? The intrinsic value might not be equals to book value, even though it is the real value, but the intrinsic value, right, is not an accounting, so it's not equals to accounting concept. So it's not equals to accounting concepts in the sense that intrinsic value is given by cash flows, CFs. Yes, that's right. Intrinsic value is like accounting for future cash flow. Yes, you're right. So it's the present value of cash flows is the DCF. So yeah, some of you already know discounted cash flow. So intrinsic value of looking at cash flows is not equals to accounting numbers, which is what book value is trying to give, accounting numbers here. That's a very good question. Okay. And one of the key concepts that we need to understand is that in order for valuation to make sense, we need to understand this concept of efficient market hypothesis. Okay, so we have next slide which can explain this. And this efficient market hypothesis is a recap as well. We have covered this in FIN 203, but let's do a recap on this, right? So what's efficient market hypothesis? And even though it's on the screen, anyone like to say in a simple terms, what does it mean? So the question is, what is efficient market hypothesis? Market reflects price. Market, okay, yeah. Some of you are getting it. Everything the market is priced efficiently and fairly. Basically, the fact that market is rational. Okay. So I like the last two answers. Yeah, we are getting there. Market is fairly priced, no discrepancy. Yeah. Okay. So we are getting there. Yeah. Those are absolutely all correct, right? So the idea is that let's think about it in a simple sense, right? Before we go into all this detail. In a simple sense, right? Efficient market hypothesis basically says that if the market is efficient, the amount of risk that you take will equals to the amount of rewards. And you should not be getting more rewards if you take on a bit of risk, right? So it's not that you cannot earn rewards. It is that if you take on X number of risks, you're going to get X number of rewards. So there must be like there's no discrepancy like some of what you say, what some of you say. There's no discrepancy. The price, everything is priced in. You can earn some rewards, but it's never excessive. It's never abnormal, right? You earn based on the amount of risk that you have taken. So let's look at it more formally, right? So more formally, efficient market hypothesis says that the stock price are equilibrium, they are fairly priced, information is efficient, so information is flowing everywhere. So in this sense, right, you should not be able to earn, suddenly a lot more than the market. All of you should earn market returns. So efficient market hypothesis does not imply that the investor cannot earn positive. So like what I say, you can earn positive returns if you take on some risk, right? But you cannot earn excessive amount of returns. Okay. And generally, you can only earn market returns because information is efficient, stock are all very fairly priced. So you only earn the market returns. That's all. Is Nvidia okay? So it depends on where you enter the market, right? Let's say, so this is a valuation question. Yeah, so is Nvidia abnormal? Some people might say no, right? Because if you have already kind of preempt the AI boom, then the rise of Nvidia is actually not um abnormal. Of course, if you're going to compare if you buy Nvidia and you earn maybe 30% return, and you compare your S&P 500, I think S&P 500 for the year of 2024 earned around 15 or 20%. So Nvidia, you have kind of earned, let's say, I think 30%, which is maybe I don't know, 10 to 15% more than the market, because market return is usually measured by S&P 500, right? So yes, then you have earned a bit of abnormal return. But let's think about that question. So it's a very good question, because if you think about it carefully, let's say if you are so high risk, or you are a risk taker and put all your money in Nvidia. Now, you have taken on a lot of risk by putting, let's say, all your money in Nvidia, and because of that, you have earned returns that's higher than the market. Then fine. Then you can you see that you have taken more risk, which is why you are earning more than the market. So it's actually, still going back to the efficient market hypothesis, right? Now, let's say you did not put all your money in Nvidia. You have put, let's say, 50% of money in Nvidia. And then because you are like, oh, I should invest in some kind of tech cheap kind of company, you think of putting, or you actually put 50% of money into Intel, right? You say, oh, Nvidia, Intel, about the same, okay, obviously it's not the same, but let's say you didn't really do your research carefully. You say, oh, Nvidia, Intel, yeah, some of y'all know, right? Wow, shit, because, Intel actually dropped quite a bit, right? And so, say on a portfolio basis, 50% Nvidia, 50% Intel, maybe net, you might have just gotten the return of S&P 500 of, let's say, 15% for the year. Right? So, can you see how efficient market hypothesis is playing out? Yes, okay. If you want to balance your portfolio 50% Nvidia, 50% Intel, maybe net you're still getting market. But if you're going to 100% in Nvidia, of course you earn more in market because you're taking on so much risk. What if Nvidia fall for whatever reason fall very deeply, then you have lost all your investments. Right? So I hope you can see or appreciate the idea of this. Now, in the efficient market hypothesis, uh, we know that when there's new information, so what this graph trying to say, at time zero, there's new information coming in, right? So in a efficient market like this, the price of the stock supposed to just go up, straight up and flat. Now, this is a efficient market. Of course, we know that it's never the case. If you just look at, I think now it's the time of bank earnings. Oh, sorry, last week was bank earnings, right? A lot of banks came out, Wells Fargo, JP Morgan, you see all the stock price all going up because they have record earnings last year. But you notice that most of the time there is a bit of a delay in terms of reaction, right? So if bank earnings, the price go up gradually as it take, whether it's a couple of hours or maybe sometimes even at the end of the day, right? Or sometimes there might be some overreaction happening. So in the overreaction meaning, the price go up and then later, there's some correction that take, bring the price down. And in both cases, whether it's a delay, reaction or overreaction, it has kind of showed you that, you know what, maybe the market is not that efficient after all, right? If it's so efficient, it should price in at the exact dot of the price of the new information, and it should just stay there, right? So because of this, we know that maybe the market is not that efficient. So in this hypothesis, we do have three type of hypotheses. First, we call it the strong form, semi-strong form, and weak form. Okay, so in a strong form, okay, so what does this mean? So we'll go into details, right? So let's look at strong form first. What does a strong form mean? A strong form means that it reflects all information. So this is the important part. All information is included in the market. So this includes public and private information. So both information is all included in the market. And because of that, there's actually no point you try to beat the market. There's no point for you to pick a stock like I want to buy Nvidia. There's no point because everyone would have information that you have in deciding that you wanted to pick Nvidia, right? So because of that, investors cannot earn any abnormal return. Let's say you feel that there's AI boom, everyone will have known there's an AI boom, and because of that, regardless of the type of information, whether it's private or public, you will not earn any abnormal return. And in this case, maybe what you want to do is just to buy S&P at S&P 500, right? That's a diversified portfolio, and you just get market returns. Everyone just get market returns. Of course, this is a very extreme theoretical form. This is not true in the market, as you know, because if you have private information, you can earn a lot of money, right? And political evidence indicate that the market is actually not strong form. So this is just is a hypothesis, right? That if it's considered strong form, then there's you impossible to earn abnormal returns. Okay. What kind of information is included in Chinese companies for it to give it such a discount? I'm guessing what you're trying to refer to is that the Chinese companies are not doing well, right? The stock price are very low. So what are the information that is causing this? So if that's your question, so as you know, there are actually a lot of more political reasons why the Chinese companies are not doing too well, a lot of economic reasons. And these are actually, in fact, in this lecture one, we are going to cover various tools to analyze the political situation, the economic situation, or even the industry kind of situation that is causing a company not to do well, right? So some issues or some factors, I would say, are not idiosyncratic. So if you listen to Bloomberg News or even finance news, they always like to use this word called idiosyncratic. So what does idiosyncratic mean? It means that it is unique to the firm, right? So idiosyncratic means something that's unique to the firm. So you notice that for Chinese companies, right, a lot of the issues are not idiosyncratic. They are not unique to the firm. They are more market situation in China that's causing whatever situation that's happening. Yeah. So pattern analysis. Yeah, right. So we're going to talk about pattern analysis as well. Okay. So that's a good question. Now, okay, going back to semi-strong form. So in a semi-strong form, right? Now we semi-strong form only includes public information. What does this mean? It means that if you have private information that is communicated between you and a client, or somehow you get private information, you can actually make abnormal returns. But of course, this might not be legal, it might be illegal. But if you have if you have public information only, then you cannot make abnormal returns. What does this mean? It means that if you use fundamental analysis, which is the purpose of this course, meaning doing valuation, right? You do valuation. Usually, this is based on financial statements, which are all public information, right? So if you are going to do valuation, then there's no point because you are not going to lead to any abnormal returns. You are just going to get market returns. Nancy Pelosi, yeah. Oh, that's so long ago. Alright. So moving on to the last part is weak form. So weak form means that the price only reflects past market information somehow. So market information, so this market information relates to more price and volume information. It means that if price reflect all the uh, volume kind of information, it means that if you are going to plot some technical analysis, you plot some charts, you do some plotting, because the price already reflects all these kind of market related information, then you cannot earn abnormal returns, right? So a weak form means that if you do technical analysis, you will not be able to earn abnormal returns. So empirical evidence suggests that the market is generally weak form. Of course, some traders would say that this is not true because they can earn abnormal returns using technical analysis, right? So that's up for debate. This is just a pictorial version, nothing to think about. So just to recap what we talked about at the start of this efficient market hypothesis, is to highlight to you that this efficient market hypothesis does not mean you cannot make money. You can make money, but the money you make will be equivalent or proportionate to the risk that you have taken. So going back to the case of your friend mentioning that if you invest in Nvidia, you might be able to beat the market. Totally right. But if you invest in only one stock, Nvidia, you're not diversifying. There's a whole course of portfolio management which I also teach and I really enjoy as well. But you're not diversifying. There are a lot of issues with just buying one stock, i.e., you're taking a lot of risks, right? So because you're taking a lot of risk. Obviously, if you beat the market, yeah, totally, right? You take on a lot of risk, you beat the market, you earn it, right? And so this means that you will earn appropriate return based on the amount of risk that you take. At the end of the day, efficient market does not protect you if you do not diversify, like what we mentioned, right? If you're going to put all your money 100% in Nvidia, then it will not protect you. You might have a large downside risk. So, we have, in order for valuation to make sense, we must have some inefficiencies that will allow us to make some valuation call and say, oh, you know what? Actually, this item is not priced correctly, and therefore valuation will make sense, right? That's why we bring in the idea of efficient market hypothesis. So there must be some inefficiencies for valuation to make sense. Okay, that's what I'm trying to say here. And now let's go to the step of valuation. So this is very important. Okay, so when it's important, usually I would like to highlight, I don't know, maybe I'll put a star here for you to take note. So whenever you are given a question, whether it's a case. I hope these steps of valuation will give you a nice template on how to tackle the case or how to even start doing evaluation, right? So the first step, right, is always to first understand the company's business, right? And like I mentioned, we'll be teaching you quite a few tools in the next few hours. But the idea is that okay, let's try to understand what's the business, what is the environment like first, right? What are industry? Are there any supply and demand factors, any development? You want to understand what's the industry like. That's always the first step. Okay, then we determine, from the industry, very high level, we go like slightly closer. We want to understand, okay, based on the firm perspective, where are they positioned? Are they, very competitive? Do they have large market share? Or maybe they're a very small player, right? So from the industry, we go narrower to the firm level. Okay, are they a cost leader? Are they a differentiator? What's their competitive strategy, right? So now at a firm level, we go even lower to the management. So now from the firm, we even go deeper to the management. Let's look at the management. Are they all, graduates from Ivy Leagues in the US, Ivy League colleges from the US, or are they mostly, more entrepreneurs, right? So, and what's the education like? Do we have people that graduate from finance and accounting, or are most of them engineers? So these are the things that we want to look at to determine the competency of the management. Yeah, have good track record. So that will be at the firm level, right? Do they have any reputation risk, reputation issues, right? Having done that, right, then we start forecasting the company's performance. And by how do we do that? Um, we incorporate their various corporate strategies and then start determining, the type of cash flows, forecast the sales, earnings, cash flow, right? This is the more important, cash flows. Of course, the quality of earnings as well. This one we'll talk about it in just a little bit about how do you determine quality of cash flows. So after determining the environment, then we go into the firm performance in step two. And then in step three, this is where lecture three, 2, 3, and 4 will cover, where we'll focus on the valuation model. So we do have quite a few valuation models. So we have the main one that we are going to focus on is FCFF, FCFE, dividend and dividend discount model, right? These three are all considered discounted cash flow models. Then we have the residual income model as well. Then we talk about using relative valuation, meaning ratios. And these are just the models. So remember, at the end of the day, again, I'm going to repeat many times, we're giving you tools, right? Do you have to use all these models? No. Do I have to use this, and this? No, maybe I would just want to use these two, right? Of course, you need to justify in your answer. Let's say if you are just selecting dividend discount, then you must justify. Why not? Why didn't I use the FCF? Right? And we'll talk about this FCF in much detail. So do not worry at this point in time, but just know that there's such model. And so you need to justify because these are various tools that's being taught to you. Uh, Important thing is this role of ownership perspective in valuation. Um, and what does this mean? So, and marketability and liquidity discount. So these factors, I would like to usually call it cost of capital factors. Cost of capital factors, right? Yes, public versus private. For a public firm, the cost of capital is generally lesser because they can raise fund in the market. They can issue a bond. They can do a lot of things. They issue a CP paper, right? Hope you know, yeah, CP, right? Or they can do a bridge loan. There's so many things they can do, right? So this would reduce their this cost of capital. At the same time, ownership. Ownership is very important. Whenever, right, you choose a company, first always look at the ownership. Who owns it, right? So just off the top of my mind, anyone know who owns SIA or who is a major shareholder of SIA? Temasek, or is it the Ministry of Finance? It might actually be Ministry of Finance, But i.e., I think where you're getting at is the Singapore government, right? What about who owns ST Engineering, which those of y'all who are male would know ST Engineering because they usually supply a lot of our military equipments. So ST Engineering is owned by anyone? I must say, I think not majority owned. I don't think it's majority owned, but it's government. Yes, it's still government, right? So, having a perspective of the ownership is very important because when you select a company to value, you must always talk about control premium, right? So, like SIA is owned by the Ministry of Finance. So, given that it's owned by the Singapore government, we know that the government will not let SIA fail, even in a pandemic situation. So that gives us some uh, comfort in terms of the control that the Singapore government has on SIA, right? Something like this, right? So I hope you can see that, you know, valuation, it's very dynamic, right? It's not just about numbers. Yes, in our models, we need to use numbers, but there's a lot of factors that comes to play in when valuing a firm. Now, having completed your valuation, that's not all, right? Because you have done your valuation, you crunch your numbers, but at the end of the day, what's your goal of valuing this company, right? So I hope that you can bring back the idea of what's the purpose of me valuing a company? Does it meet my objective? Okay. So what's the objective? You need to ask your investor, is your investor going to invest in a 10-year kind of investment horizon, 10-year horizon. And so maybe a 10-year horizon, you take a bit more risk. You can have longer term investment in certain companies that do let's say construction, right? Very long term projects. Yeah, what's the turnaround story? You totally right. So you need to consider the investment objective and whether this valuation or this company that have value will meet the valuation objective or investment objective that's required by you. Once you have determined that, once you have crafted a nice story, you say like, oh, wow, you'll meet my objective because of X, Y, Z, then you finally make your recommendation and say, okay, because of your analysis of the industry, your detailed analysis of the company and all the macroeconomic, all the things that we talk about in step 1 to step 3. So step 1, 2, 3. Then you finally come up with a valuation, and then this is the last step, then you make the recommendation and conclude, okay, because of everything I've done, you should invest. Right? So that's the whole purpose of valuation. So I'll pause here for a short while. Any questions regarding the steps of valuation? All right. Great. So like I mentioned, when you look at your assessment, when you do any kind of valuation, please use this as a good template in tackling those questions. Drag and tag along rights is part of ownership. Do you think you can explain what is a drag and tag along rights? I've not really heard of this term, drag and tag along rights. Hmm. Yes, I would think it's part of ownership analysis. Yes. Unfortunately, I'm not expert at private equity, but I believe so. Right? If you are, yeah. Okay. Force minority holders to sell along you. Yeah, okay. So if there's this, I guess it sounds like a clause where minority shareholders have to follow your decision, then if if this clause is strong enough to be considered part of your ownership, right? It will depend on I think, the phrasing of the clause or the rights. given to minorities or taken away from minority shareholders. Okay. Okay, so going back to this fundamental analysis, what is fundamental analysis? We won't really talk about this. Basically, the idea is that you just want to do some charts, whether is it like this candlestick, there's some candlestick here, and then you plot some lines, oh, okay, there is a gradual uptrend, so you should invest now because the price is going up, something like that, right? So fundamental, sorry, what are we talking about? There's technical analysis. Why am I talking? Okay, so repeat. So fundamental analysis is about valuing a company, right? And this is what we're going to do, meaning that we are going to look at the financial statements. We are going to try to identify any stocks based on the four steps that we have talked about, the first four steps, and based on the first four steps, whether any of these companies are not valued correctly, and therefore it's good to invest in at this point, right? Okay, so generally, you want to short or you want to sell any things that's overpriced, right? And you want to buy anything that's underpriced. You know, I like the comment on quantum computer. So, if you have invested in quantum computing last week, I mean, actually not last week, early last week or the week before last week, then this week you have made 55% return on quantum computing. So I guess it really depends on when you invest, right? So if you have done your due diligence on and you have done fundamental analysis and you have invested it, I think on 1st of Jan, right? You invest in quantum computing on 1st of Jan. I think by somewhere between, I think 1st of Jan, somewhere around early Jan, maybe let's just say first week of week week 1 of Jan, in somewhere between I think week 2.5 of Jan, you have made 55% return. Just yeah, double, just almost double. Just out of within a couple of weeks. So, the market is quite interesting, right? So if you follow a market, it's quite interesting. So yes, maybe quantum computing um it's not at its maturity, right? But it doesn't mean there's no money to be made, right? You can still have made 55% within 1.5 weeks. Okay. But of course, we are not in this course, we're not talking about trading. We're not trying to teach you how to trade, even though it's quite fun to actually have the knowledge as well. But we're trying to do more fundamental analysis, right? Hopefully you can land a job as a equity analyst, investor in to write equity reports. Okay, so in equity, as an equity analyst, you want to kind of forecast future cash flows, you want to consider the riskiness of cash flow by talking about the discount factor. So like I mentioned, what is the cost of capital? Okay. So in the next lecture, we'll talk about this in more detail. I hope you remember your WACC. All right. You need to adjust your of course adjust your cost of capital as well. And at the end of the day, you want to buy something that's undervalued and sell something that's overvalued. A bit more overview on fundamental analysis. There's a top-down approach. So top-down approach is what we initially talk about in your first step one, step two, step three, where you go economic analysis first, then you look at the industry, you go down to a company, and then finally you look into the company and do your discounted cash flow, you do all your cash flow analysis, and only then you say, okay, you know what, because of all the steps one, two, three, and four. Therefore, I say that it's good to invest in, let's say, Samsung, right? So what does it mean? So in simple terms, we first look at the outlook of Asia, and then within Asia, which country is promising, and then from there, we look at which industry is promising, and then finally, we determine that, oh, you know what, maybe the IT industry where Samsung is the one that we should invest in. So really top-down approach. This is a diagram. You can have a look at it yourself. And then we have the more the bottom up approach, which more or less, as equity analysts, most of the time we follow this more, even though actually it's not that good, because a bottom-up approach means that you already have a suspect, right? And the idea is that when you have a suspect, you already have some bias, right? For example, oh, you are kind of very interested in tech, right? And so you are more focused onto the AI story. And because of that, you already have some bias, right, on AI story. And because of this bias, you might kind of block yourself from seeing a lot of the other companies that might actually be beneficial to invest in as well, right? So a bottom-up approach means that you have already a suspect company, and then from there, you look at, okay, the industry. How's the industry doing? How's the economy doing? And based on this, we say, okay, let's invest in this company, right? So from a bottom, normally, like I mentioned, it's not so good in a sense because you already have some bias that's there. All right, so this is just a diagram for you to see what's the difference. Now, we're going to use the top-down approach in our course most of the time. So, we're in lecture one, what we're going to cover actually is a lot on the um, qualitative component of your analysis. And I would say lecture one actually can be the one of the most important lecture because your qualitative component, right? This generally make up 35% of your marks in a valuation report. So 35 to 40% of your marks all come from just your analysis, whether you have done your analysis correctly. And all this is just going to cover in this lecture. So I really encourage you, if you do have any questions, do stop me and so that we can go through your doubts, right? Now, from lecture to lecture six, that's where we go in depth into the valuation techniques. And of course, if you put in the wrong cash flow, you put the wrong discount rate, your whole valuation is wrong. So also very important, lecture two to lecture six, and this usually accounts for maybe 60 to 65% of your marks. Okay. So this is easy to get the marks for your qualitative component, but then you need to be very careful on how you write it. For your quantitative component, we lecture 2, lecture 6, it's very easy to make mistakes. So you just need to be very careful and justify why you use certain things, right? It's always about justification. Because you know what? At the end of the day, everyone is going to get a different valuation, even though they value the same company. And so there is no right or wrong answer. But it's about really how you justify, right? How you make your assumptions. So later we'll talk about this in much more detail about assumptions and justifying. This company, so which company is it? Quantum computing? AI. Nvidia. Well, I guess it depends on your analysis, right? It depends on what you have analyzed in terms of the qualitative environment. For example, the first thing I'm going to talk about is economic analysis, right? So, let's try to identify the economy, right? So is the economy going to capitalize on the NVIDIA trend, the AI trend, right? So let's look at the economy because the economy actually is quite broad, right? There's a lot of things to consider in the economy. So this is a good comment here that I like to highlight. An asset, meaning a stock, with low expected payoff during weak consumption. So what does this mean? So what kind of, okay, a question to all of y'all, what kind of stocks will have a weak consumption or sorry, a low payoff during a period of weak consumption? Anyone can come up with a type of stock? Cyclical, okay, like what kind of products? Like what kind of cyclical products? Luxury good. Oh, okay, I like the luxury goods. Okay, Walmart. No, that's not correct. So you're right. Luxury goods is one of them. What does it mean? It means that this in the luxury market, the payoff is going to be low where there's big consumption, right? People are not going to buy luxury goods, so the payoff is going to be very low. This kind of products would have higher risk premium, which makes sense, right? Luxury products have uh higher premium. I saw the comment. SIA, yeah, maybe travel when economy is not doing well, you know, would generally have lower consumption. Now, when as compared to something, a stock that has high payoff in a weak consumption, so high payoff weak consumption, this is more on your defensive industry, like what one of you mentioned, Walmart. Bitcoin, well, okay, Bitcoin doesn't follow the economy, but it follows a lot of other policies. Okay, so we understand also the link-lag relationship between the economic factors. So this is very important, link-lag relationship between the economic factors and how the market moves. Okay, so before we move on to this, let's take a short, 8 minutes break. We'll come back around 8:10. Um, and during this time, please try to form your groups. If you can, after forming your groups, do send me your group or email me your group members. And if you can't form your group, that's fine as well. Okay, so let's just take a break till 8:10. Welcome back. I saw a comment that some may say you created group list in the tutorial group. Yeah, in Canvas. Feel free to do that. You know, uh, if it's easier, yeah, just you can create a group that you can join. But please also, once you have joined, confirm your group, do send me an email on the groupings. That will be your final group, right? So you can create the group on Canvas, and then eventually, after you have like decided on the members, do drop me an email because I'll take your groups in the email as your finalized groups. Okay, yeah, feel free to do that if it's easier for you. Okay. All right. So I also want to highlight something about the GPA is that this GPA, unlike other modules, this GPA can be very heavy. Okay, so I really encourage you, first of all, if you are a non-finance student taking this as an elective, try to group with some finance students. But not only that, right? I really encourage you to work on the GPA together and really start doing it as early as you can because this GPA is very heavy. As you know, the whole purpose of this course is about valuing a company, and um, you know, part of the valuation or part of your GPA is actually doing that, right? So valuing a company can a lot of time because you need to look through the financial statements. It can be quite time consuming, right? So really encourage you to have a look at it, try to have some ideas for the time being first, right? Because it can be quite heavy. Okay. Now going back to where we have stopped. So what's economic analysis? So economic analysis, right, is looking at the economy. And one of the key factors of the economy is looking at the GDP. So what's GDP? So GDP, gross domestic product, basically, is what are the value of goods and services that's produced during the year for the country or the economy. And it does not distinguish between seasons and non-seasons. So even if, like, let's say I was working in Canada, right? My output will be categorized under Canadian output, right? Uh, See it. Okay, so GDP is not CPI. So CPI is a consumer price index. Um, and so that's a good question. So consumer price index generally is considered a leading indicator. Yes, for inflation, whether it's for inflation, also various leading indicators for certain expectations, right? Mostly for inflation, CPI or PPI, which is Producer Price Index, they are generally used to determine how the market is doing, right? And inflation, of course, is the big concern. They are called leading indicators. And we'll talk about this in just a couple of slides, leading indicators. And your CPI or PPI are key matrices for inflation and leading indicators. Okay, some more terms. Recession is defined as two quarterly decline in terms of uh, uh, GDP. Any GDP gap or output gap is given by the actual GDP minus expected, right? So if there's some gap between the actual minus expected, that's your output gap. So why do we need to do economic analysis, right? Because at the end of the day, right, when we value a company, the company, i.e., the stock, is in the capital markets, and the capital markets is being affected by economic factors, right? Whether it's GDP, whether it's things like inflation. So we need to understand the economy, then we can kind of decide how the stock will react, how the stock is doing in the market. Macro is king. That's true. Really understanding the political situation, understanding the economy will give you good insights to know where to invest or what to value, right? That's why you do a top-down approach. You look at the economy, then you go down to which firm you want to invest in. Okay, understand the direction, strength, lack, relationship to forecast where are we going in terms of the economy, right? Okay, so these are just some general comments. if the economy is doing well, people have higher disposable income, higher savings. More savings means there'll be more loans distributed out, um, higher production, more workers are hired. So all these are just a cycle, right? That it repeats itself, and then more investment economy. Um, and one of the key leading indicators that one of your friend mentioned is the CPI, where it kind of provides you idea of where the economy is going. Um, where is it here? Consumer expectation of the business. So this is kind of equivalent to your CPI, right? So this gives you a good indication of where the market is going. Of course, there are many other leading indicators as well. Okay, this is very interesting. I always like to talk about this. So bonds. So bonds, right? A lot of people is very familiar with treasuries, right? Treasuries, meaning treasury bonds. In the sense that what does treasury bonds generally indicate? Well, what do they actually tell you about the market? So let's risk-free rate, right? Okay, so that's right. So risk-free, sentiment. Okay, I like that comment on sentiment a lot. So yes, generally people think about risk-free immediately, right? So uh, risk-free rate. Now, this is more of, I would say, when you are kind of in kindergarten in finance, right? So usually, let's try to think about these bonds people, because bonds are very unique in the sense that give you a lot of information about the market as an excellent leading indicator. So the question is, there's a comment that means sentiment. So actually, what determines the bond price? Anyone knows? Supply and demand, yes, that's one of it. Interest rate, no. Okay, yeah, interest rate is inversely proportional to bond price. You are right. But actually, what drives whether it's interest rate or bond price? Okay, I like the comment. Market participant expectation of future interest rate. You are totally right. So, hope all of you all can understand this. This is right. So, it's not about yes, bond price inversely proportional interest rate. Then you question what drives interest rate. Yes, it becomes a cyclical, circular argument, right? But the main thing is the expectation of future interest rate or expectation of future inflation, right? So this is important because in we know that treasuries gives you risk-free rate. Risk-free rate gives you the discount rate for your discounted cash flow. But the question is, okay, which bond yield should I use? Should I use the 1 year treasury, 2 years treasury, 5 years treasury, 10 years treasury? That the question endless, right? And then the question comes about okay, maybe you look at the market. Why is the 30 years treasury? Why is the 30 years treasury giving a lower yield than your 1 year treasury, right? So this is all about what your friend mentioned about the expectation of inflation. So, in understanding this, it will help you kind of decide first of all, what um, horizon or tenor of your treasury bonds you want to use. But not only that, it helps you understand what's happening in the market, right? It gives you a leading indicator. Yeah, right. The inverted yield curve. So we are going a bit deeper. So some of y'all will know about this already. So the inverted yield curve is actually causing your long end treasury to give lower yield than your short-term treasury. And this means what does it show about the expectation of the economy or maybe inflation? Yes, inflation, I see recession risk in the long term, right? So there's a built-in on, how um, the economy is not doing too well in the future, which is why, the long end is still giving lower yield. But they say they are wrong. Okay, Okay, there's some comments there. But yeah, so what I'm trying to drive here to you is that the bond yield or bond price is a very good leading indicator to know what's happening in the economy. As we know now, as inflation, you know, gets uh controlled, our interest rates on the bond, the short term supposed to drop, bond price supposed to increase. Generally, a uh, longer duration bond, meaning a bond with a longer time horizon, 30 year, 10 year, supposed to be more sensitive to interest rate changes. But in this case, in the current economy, it's very unique because your long end bond is not responding so much to changes or reduction in interest rate because there is expectation of inflation not going down, right? And the yield curve continues to be inverted. Okay, so the question is why 10 year? So, okay, I'm not saying that the 10 year equals to risk free. Generally, the 1 year is considered more risk free because it's the most liquid. But then the question is in a valuation, which bonds we use. So we need to consider the tenor of your okay, you're totally right. So use the tenor that matches the company obligation or matches your valuation horizon. So if you're going to value the company and you're going to hold the company for 10 years, then you better use the 10 years treasury because that is the rate that you're going to use to discount your cash flows. So you're right. Use the tenor that matches the company's obligation. All right. There are some challenges to using leading indicators. Of course, something that leads doesn't mean that it will repeat itself. People always think that history repeats itself. Um, as in most people that try and value companies, that's what they think. Because if they look at some historical trend, they expect it to repeat, but not necessarily true, right? Sometimes there can be some false signal, contradictory signal that changes the patterns. Um, of course, there's high variability as well. Data changes, um, trend changes. So things can change, right? So this is the whole list of leading indicators. All right. We do have some lagging indicators. The important one that I want to highlight to you is things like employment, right? Employment is always very lagging, right? It lags behind the economy. So, for example, during the COVID situation, right? The COVID pandemic, there was a sudden shortage of skilled labor. And we see that most employees became empowered with lots of negotiating power to push up their salary. Right, that is during the COVID period because there was a shortage of skilled labor. Now, post COVID, we saw that this continued to be true for the first, a year and a half. Right, it's only now, which kind of lags, right? It's like after so long, already, it's only now that we start to see the slow, weakening of the employees' negotiating power because even though the market is no longer in shortage, it took a while for the employment um, to kind of catch up with the market situation. So now we see that if you look at market in terms of landing a high paying job or getting a job that you really want, gets tougher and tougher, right? It's no longer an employee market, it's more an employer market now. Okay, we have some coincidental indicators as well. You can have a look at it if you're interested. Okay, so we talk about economic analysis. Let's look at some business cycle trends. So generally, a business cycle lasts 9 to 11 years, and it fluctuates, right? From the peak and then it goes to the trough. Um, this just to mention again, what's output gap? Output gap is the actual GDP minus what is the potential or the trend GDP. Um, so the amount of gap provides you some information about the future inflationary pressures because the gap gives you what is the actual minus what is supposed to be, right? So if there's a large gap, then maybe you'll become a bit more concerned. Generally, there are 5 phases in terms of business cycle. So we do have the initial recovery, right? So initial recovery, it can be, some people will say now is initial recovery where we see inflation starting to fall, short-term rates becoming very low, right? Business confidence is rising, people are spending more money, unemployment might be too high. This one, I don't know, it's a bit questionable, right? Bond price tends to peak at this period of time. On the long end, so the long end, maybe not so, right? The long end, I put some question mark because at the long end of one price is not peaking, right? Which is a very strange situation. Might be supply and demand, or like what we talk about, people are still very uncertain about the future prospect, at least at the 30-year mark. Maybe they are quite certain at a 2-year or 5-year mark, right? Stock may rise strongly. I think just yesterday, S&P just hit another record high, right? So yes, stocks are still rising very strongly. Of course, this can be due to many factors that not necessarily because of the economic condition. So we need to dive deeper to really understand why. But of course, the S&P just hit a record high yesterday, so maybe we're in the initial recovery. Um, Early upswing. So early upswing is, now we are swinging up already, right? Business is starting to build more inventory to sell more. People are spending more. Unemployment has reduced. Inflation remain low. Why I think we're not in the early upswing? Because inflation is still not at its the low point, right? Not in where it has started. But some may argue that it is actually at the early upswing because inflation has now, or the new R star, they call it R star, meaning the sustainable inflation rate has now increased. So maybe this is the lowest we can go. Who knows, right? Short-term rate remain low. Central bank starts withdrawing any of the monetary stimulus. Bond price is stable. Debatable. Now the bond price is still quite here and there. Stock trends up. In the next cycle is more of the late upstream cycle where the consumer confidence is high, output gap has closed, inflation start to rise because as people have more money, more inflation, um, short-term rate would increase, okay, bond price would fall, um, and stock price would peak. After you have reached the peak, that's where you start feeling the slowdown. That's where confidence waver. People start cutting back on big items spending. Spend less. Inflation continue to rise as well. Short-term rate will peak. Bond price bottom. Um, the bond price will go very low. The yield curve generally is inverted, which is now, right? Now the yield curve is inverted and stock price is falling. So it's a bit, yeah, here and there in this market, I would say. Recession, of course, is 2 successive quarterly decline in GDP. So recession is usually quite bad. That's where there's no confidence in the market. There is downward pressure on the inflation. Inflation falls. Short-term rates continue to drop. Government bond price increase because people are quickly putting all their money into bonds now because in a recession, bonds are less risky compared to equities. That's why we see bond price rising as well due to demand factors. Um, and stock price will be at its lowest. So there are some factors that affect the business cycle. Majority is consumer based, so 60 to 70% is consumer based. Business do actually affect as well, and some foreign trade policies will affect the business cycle too. Okay. Going focusing on more government policies, let's look at what's fiscal policy. So fiscal policy generally refers to how much the government is spending or cutting tax to stimulate the economy, right? So for example, during the COVID, we do have some fiscal policy where the government try to maybe increase construction projects or try to, or not during COVID, but post-COVID, right? Try to re-stimulate the economy by, spending more money in the economy to get the economy out of the slump. Right? GST vouchers, yes, those can increase to encourage increase in spending as well. Or it can be considered monetary policy because we're giving out or increasing money supply as well. But given that it is from the government, yes, it's a fiscal policy, right? So it's not from the central bank. Okay. Um, Okay, just some further comments when economy is growing strongly, deficit naturally fall, and focus on deliberately changing the situation. For example, giving GST vouchers. So for monetary policy, that relates more to what the central bank really can do. And this includes, interest rate and money supply. So, whether they are increasing the money supply or they reduce the rate whenever there is a weak economy, right? And then if they want to restrict the economy, they decrease the money supply and they raise the short-term rates. So, maybe just a simple question. Why will the economy be restricted if they increase the short-term rates? Yeah, QT. So, yeah, less loans, more expensive. Yeah, that's right. So you guys will know, yeah, so it's more expensive for the companies to go into projects, take on more loans. That's why it's going to restrict to slow down the economy. Totally correct. So this is the summary of government policy. They can use fiscal policy or monetary policy to accelerate or to loosen the economy or to slow down the economy. This is more on the business cycle thing. So we are going deeper already now. Yes, it's part of economic analysis, but let's look at the business cycle. Where is the business industry at? Is it peak? Is it at the trough? Is it in a process of contracting or expanding, right? So let's look at the business cycle. So there are certain kind of companies that are generally preferred in a certain kind of business cycle. For example, I think earlier I saw someone mention about natural resource company when the economy is doing well. You're right, at its peak, usually natural extraction or resource company, like oil and gas company, generally do quite well. Of course, at a contraction stage, that's where more defensive industries such as food, Walmart, that kind does better. Expansion, that's where your consumer durables come about. And it's 12 January, you look at capital products, right? Because capex products are more stable. So at its bottom, that's where we want to invest more in capex. So this is just a diagram of sector rotation, right? Okay, so I'll just pause for a short while here. I hope you can appreciate, right? So far, what we have been going through on the qualitative side of things, hope you can identify that we're actually introducing certain tools to you, right? Um, Tools in the sense of, okay, now let's try to analyze the economy using whether is it the government policy, whether is the government using QT or maybe some fiscal related policy, right? So I hope that these are giving you some stimulating some ideas for you when you analyze a company, right? So when you think about the economy, okay, I should talk about certain things about maybe the government initiatives. I should talk about maybe the business cycle. Is it expansion or contraction phase of the business cycle? Is there going to be a sector rotation, right? So these are the things that I talk about when I mention tools. So hopefully all these slides, right? You do not need to ever memorize them, but hopefully it stimulates certain kind of conversation in your mind to think about these topics and translate them into your valuation report. Okay, so there's just a bit more information on economic analysis. You can have a look at some of these links. Hopefully it will work. I'm not sure. I should have checked it before I post it, but yeah, let me know if you can't find any of the links. Okay. Uh, All right, so industry life cycle. So now from the economy, so can you see that we have been talking about economy, right? So we are going deeper now. We are going to the industry, right? So we're going top down, right? So we are going deeper to industry now. And the industry generally things that we consider are, okay, what kind of industry are we in? Let's say the AI boom. Where do you think we are in terms of industry? Are we in the pioneer stage? Are we in the growth, the maturity, or decline for AI boom? Growth, yeah. Okay. I think I see most people, the consensus is growth. Totally right. We are growing very quickly in terms of the AI boom. Um, Definitely not in the maturity. It's not mature yet. We do not have a lot of the whether it's power, whether the data centers to support the AI. Pioneer stage. Some people might even argue it's at the pioneer stage, given that we just started the AI boom, right? It's just at its infancy. There's not much, I would say, a lot of industry practitioners say there's not much real uh, life pace of AI in the industry yet. All right. It has only just started on the whole chat GBT, but even that is just one platform, right? There's not really a lot of use cases of AI in the industry, daily use cases, right? We're not talking about just asking a question to ChatGPT. We are talking about real life case that enhances the productivity of somebody in the company, right? There's not much of this. Yes, there might be some small little, tweaks here and there, but not really very substantial. So because of that, people might say it might still be in a pioneer stage, right? Yes, it's going up the growth, but maybe we are just somewhere here. If any of y'all have any real life cases of AI that's being used in a company that is interesting, that would be nice to know. Of course, I'm referring more not just to answering a question or doing some calculations, right? Really like substantial good cases. That I think will be an interesting topic. So pioneers. So what is the pioneer? So this one, maybe I'll not go through everything. Basically, pioneer is you're just starting to develop a new product, which is why I say the AI part is still quite still trying to develop something, right? Not necessarily, feel that it's at this stage yet. Growth if the product has been accepted into a market, consumer wants it more, there's a ramp up of demand. So yeah, maybe you can also argue as a growth because there's a high demand for AI. But the thing is, a lot of people do not know what AI they want, right? AI is such a big name. Like, yes, we want to incorporate AI, but what AI do you want in your company? Right? It's still such a broad umbrella of things, right? So what do you really want? Can we are we able to capitalize on some economies of scale? Of course, there is funding, but then you need to have a value proposition on what you actually want in AI. Amplifier. Okay, what are you trying to amplify? Product diversification and innovation. Yes, there's a boom of innovation, different types of probably use cases that will be interesting, but none have really, shaped the sector yet, or is still shaping, I would say, still shaping the sectors. Depending of competition, yes, we do see some competition, but still, quite limited, I would say. Okay. Yeah, so it helps you code the script. Yeah. So far I think those are very useful, right? Help you code, fix certain things. Yeah. Automate your workflow. Yeah. So it enhances your overall work experience. Yeah, it does. The AI does help you enhance, but it is not like a full use case, if you kind of get what I'm trying to say. It's not like it's going to change or remove away a whole portion of work that you don't have to do anymore, right? This seems that your comment seems to say that, okay, it helps you do this. It's more like tweaking, doing a bit of things, but the question is, does it really change or remove the need for you to do an entire scope of work? I think that would be an interesting use case, right? To remove the entire scope of work that you have to do. In a maturity stage, this is more of your products that has been there for a long time. It's mature, it's accepted already by the consumer. Um, there's need for more innovation to be a differentiator of your products. At the same time, you need to start slowly protecting your market share, because as more and more competition comes in, because the market is so mature, then you need to start, kind of innovating and protecting the share of market that you have acquired. Okay. There might be some change in demographic and consumer patterns as well. So one example I'd like to talk about consumer patterns is the idea of shifting interest in EV cars. So as if you follow the market, you know that EV cars is having a very difficult time in the changing consumer demands and consumer patterns, because people are thinking like, hey, you know what? If there is the idea of hybrid, why do I want to go pure EV, right? Even EV has so many restrictions here and there. So there's a slight shift in the consumer demand. They no longer want to consume purely electric vehicles. In a decline stage, the product's no longer in demand anymore. Market shrink, industry consolidate, it reinvents itself to stay alive, right? So a good example is your DSLR cameras. So how many of you all actually had DSLR cameras, you know, mirrorless? Okay, mirrorless is already quite more advanced, right? But any of you have the traditional DSLR camera? Because unless you are a professional photographer, you probably will never buy a DSLR camera nowadays, right? Your phone is good enough, right? Yeah, some of you are not even familiar with a DSLR camera. So it's your big chunky camera that is used for professional photography, but at one point of time, everyone has it, right? Whether you're professional, whether you're just a hobbyist, you have a DSLR camera. But now you just use a phone, right? So the product is, of course, this camera. It becomes very a niche product. The demand is declining, the market is shrinking, there's some consolidation happening as well. They of course need to reinvent themselves, and that's why, I think you mentioned mirrorless camera, so they did came up with the mirrorless camera, but now maybe the process is becoming more focused on just phone cameras, right? People feel that phone cameras are actually good enough, right? It has reached a stage that phone cameras have caught up with in terms of quality with more professional cameras, right? So maybe not required to have these DSLR cameras anymore. So an interesting thing is because the other day I was trying to sell my DSLR camera on Carousel. So I bought it, of course, about 15 years ago. And at point in time, 15 years ago, it cost me 2.4K to buy the camera. And then eventually I sold it off I think 2 or 3 months ago for only $150. So that's the depreciation is insane. Where industry decline means that we should tilt towards company that have strong financial position or acquire market share when the company fails. That's a good point, right? I like the comment you made. Good companies in that industry can still can grow. You're right. So I guess if the company is good enough, you can still innovate. You can still try to grow and see where else can you, what other markets can you tap in, whether is it something that has not been tapped on before, and then try to tap on those markets. So generally, in a declining industry, if we try to find good companies that to have innovative solutions, I think we can still go from there. Very too addictive. Yeah. So yes, you're right. So there can be still certain markets to take on, or say, right, Philip Morrison, maybe, okay, so I'm not familiar with where they sell their products. Maybe let's just say they do not sell in China, right? Or they have limited presence in China. So if they can take a new market, given that Chinese consumers actually smoke quite a lot. They are one of the largest smoker communities in the world, right? So if they can tap the Chinese market for whatever reason that they have not tapped for the last decades, then it might be possible for them to still weather through the decline industry life cycle. Okay. Industry types, we do have various type of industries depending on where the company is placed. It can be a growth industry, particularly your AI, your new technologies, defensive industry, generally your utilities, consumer products such as your food, grain, um, government contractors, so very stable, whether is it usually in the mature stage. And the thing is, generally they do not fluctuate much in terms of they don't fluctuate based on economy much. Last but not least, they're more the cyclical kind of industries. Of course, the cyclical industries has higher risk, right? Higher risk, increased risk, and it generally means also you get higher returns when the economy is doing well, and you make more losses when the economy is not doing too well, right? It follows the economic conditions. So we do have this, probably this is not uncommon to you. Have everyone seen these Potter's five forces? Yeah, okay. So yeah, you probably have touched on it in various other courses as well. So this is one of the tools that I'll encourage you to also see whether it's appropriate for your valuation when you're doing your equity valuation. So we have many components. Um, I did a short write up of each of the components, so you can just take the time to have a look at it, right? So for example, the first part is whether is it easy to enter or exit, so new entrance into the industry, um whether there's some competitive pressure. Important thing to take note is about entrance to barriers to entry. So for example, if you are in the utility space, right, you are producing electricity now because of the high capex, chances are the barriers to entry is extremely high, right? In order to compete in the utility industry, you need to build a power plant. That will take you years, right? So the barriers to entry is very high, which is why the utility or electric or power generating sector is quite a defensive sector because it's hard for people to enter the market. Barriers to entry includes large capital requirement like in your utility to build like a power plant. Maybe there's a bit more strong brand loyalty. For example, your Apple products, proprietary knowledge. These are things like your vaccine, your RNA vaccine for COVID. Maybe there's high switching costs as well, and then government policies, right? High switching costs, for example, you use things like iCloud for your for your I don't know, iPad or what. So it's the cost of switching is quite high because it's so difficult to switch. Rival amongst existing firms. So existing firms can also uh, 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 compete with each other to expand their market share. So a classic example of this, is your cold storage versus NTUC, right? They all try to increase the market share. Of course, they are differentiated because your cold storage generally cater to more premium products versus your fair price, which is more economical products, right? But of course, they all try to expand the market share in terms of um, grocery stores in Singapore. Yeah, the comment on SAP, that's right. So SAP, for companies that use SAP, they realize that they are too intricately entwined in the whole SAP universe that it's almost impossible for them to change to a different system, right? So a lot of these kind of accounting software, they get you so intertwined that it's almost impossible to do a full revamp. Slow growth, high fixed costs in terms of rivalry, or let's say if the product's homogeneous, it will lead to very high competition, right? So let's just think of homogeneous products. For example, your bubble tea, right? Your bubble tea, these are products that are rather homogeneous, right? Yes, there might be some nicer ones, might be some that's not so nice, but generally it's just bubble tea, right? Everyone can make it. And if you get a good recipe, you make it, you can compete. And that's why competition is usually very high. You have a lot of local brands. You also have foreign brands that enter the market. So a lot of factors to consider. Okay, so again, there are some multiple factors to consider. So again, I want to highlight to you, all these are just tools for you to decide whether it's useful for your analysis. Of course, when you are using, let's say, Porter's five forces, right? You need to use all five forces. So please do not just use one force in Porter's five. If you are going to use the Porter's five framework, please use all the frameworks. Yeah, so now there's this Changi era. Um, in fact, I actually have not tried that tea, but I see everyone drinking it and everyone carrying their bags, the carrier bags, and use it as a shopping bag or like a stylish bag to carry around. But yeah, I've not tried it before. Probably some of you all are fans of it. 人生人海. Yeah, yeah, yeah. It looks like the Dior bag. Okay, so trade or substitute products. So of course, if certain products are easily substitutable, the competition is going to be very high to just substitute them and easily change them. A good example would be like, cotton and wool. They are substitutes. You can substitute them accordingly. Sugar and corn syrup, also a substitute product, right? So substitute products is you use the other instead of you use B instead of A, right? These are substitutes. So compared to complementary product, complementary complement each other, it encourages the use of the other products, but this is the using A and then you not use B, right? So something like that. Availability of substitutes limits the prices they can charge for a customer. So a good example is, if you are if you help your parents, buy detergent for washing clothing. If you ever, if you're a guy, sometimes your parents ask you buy because it's heavy, or even a lady, right? Sometimes you might need to buy it as well. So there are so many different detergents, there's so much substitute that sometimes maybe the option that you choose is just simply based on price, right? Oh, I just buy the cheapest one, or maybe not the cheapest, but the cheaper one, and that's my decision factor, right? I'm not really care about the brand. I don't really care about the scent and all those details, right? Or whatever they write on the bottle. So the availability of so many products kind of limits the price that they can charge the customer, because customers are so price sensitive, right? I'm just going to buy either the cheapest or the second cheapest. Bargaining power of buyers. So this is very interesting. Why I want to highlight this bargaining power is that if you look at the gross profit, so gross profit margin. So whenever you calculate a gross profit margin of a company, right, the gross profit margin gives you an indication of the bargaining power. So, when you do your analysis in terms of financial analysis, whenever you talk about gross profit margin, try to think about what does it mean in terms of bargaining power of your buyer. Anyone want to give it a try? What does it mean? If you have a high gross profit margin, means what in terms of bargaining power of buyer? High. Okay, I hope it's high. Okay, yeah. So most of you are saying high. I see one low. It means high. So if a gross profit margin is high, means that your customer. Oh, wait. High. Okay. Now I'm not sure what when you say high is what. So okay, let me try to explain to you. Yeah, your customer has low. Yeah, that's why. Initially I was like thinking, hey, actually it's no, actually it's low. So let's put it in context. Let's repeat again. If the gross profit margin is high, means the company is able to charge a lot, right? The gross profit earn a lot, correct? If the company is able to earn a lot, means that the buyer has low bargaining power. Yes, correct. Because company can earn more. Yeah, you're right. You're right. So just be very careful on this. It's quite a bit tricky. I almost got tricked by myself as well, because I know this idea of bargaining power of buyer and gross profit margin comes hand in hand, and it's very important to link them together, right? So when you think about gross profit margin, think also about bargaining power. High gross profit margin means the company has a lot of power, but means the buyer has no power. That's why the company can charge as much as possible. Okay. All right, bargaining power of your suppliers now. So on the supplier side of things, so how are you a very big customer to a supplier, or is the supplier a lot bigger than you, right? So a good example is, um, let's say Walmart buys apples from an apple orchard, right? Apple orchard, they grow apples, right? But the thing is, Walmart is so big. Apple orchard maybe is just a couple of acres. It's not very big, right? And because of that, Walmart has such a bargaining power, and it means that the supplier of the apples do not have any power at all. Whatever Walmart says that it will buy the apple for, whether is it 50 cents for apple, the supplier has no choice but to accommodate. So then the bargaining power of the supplier is very low, right? So it really depends on what the product is and how big the supplier is compared to the customer. Okay, example of course is Microsoft. They have a dominance in terms of a lot of the computers, even though now a lot of people are starting to use Apple computers as well. So there's a bit of a change in terms of bargaining power, right? competitive advantage. I guess at the end of the day, if you are trying to sell something, what is your advantage, right? Is your advantage based on cost? Is it based on different products, or is it a very niche product, right? So it depends on where you are at in terms of your competitive advantage, right? Whenever you think about lower cost, try to think about integration, right? Integration. So what does this mean? Hope some of you all know what is a vertical versus horizontal. So vertical versus horizontal integration. So something to consider as well. When something is vertically integrated, means that you integrate both your supplier and buyer together, right? Versus horizontal is different. So you integrate other parts of your supply chain into your business. And the idea behind integration is that you want to reduce costs. So you're actually using the lower cost producer strategy to actually gain certain competitive advantage. Um, okay, Potter's Pie Fosters, if you look at the various force based on the different stages of the economy of the industry, they have different importance, right? Whether it's a growth stage, shake up, maturity, or decline. So generally, when something is matured, there is usually, the buyers are very strong because it's very matured, there's higher entry barriers, maybe compared to a growth stage where there are low rivalry, high growth, barrier of entry is generally lower. So, really different stages of your um, industry will have different types of forces as well. Maybe let's take a short break again. As you know, try to do two breaks so that we can break things up, go for a toilet break. So let's just come back at around 9:10, right? So I received some emails already for your grouping. So thanks for those that have sent in. Those have who are still forming your groups, do take the time to try to form your groups. If not, we can do a random allocation as well. Okay, so let's just take a quick 7 to 8 minutes break. All right, welcome back. I do see a question. So, how many people can we have in a group? So, generally, we have four members in a group. In case you have five members, I believe we can have two groups with five members. So, so far, I've not received any five-member group. So, in case yours is a five-member, um, send it over, you'll be the first two, you can be a five-member group, right? So in case yours is the five, do send it now. So we do not I have not received any five-member group. But as much as possible, we should have four members. Um, Try not to have three members because like what I say, this GBA is quite heavy, so you really need four members to do it well, at least four members. Three members, you will struggle quite a bit. Okay. In case you have only three members, don't worry, just send it over as well. Then the fourth member, I will just randomly allocate. Right. So in case you have partial groups, of at least three members, just send it in. All right. So I hope so far so good. Is the pace all right? So with the lecture so far? Okay. Oh, it's fast. Okay. Uh, maybe I'll go a bit slower. Okay, so because it's the first lecture is more qualitative, that's why the a lot of the things. Okay, so for lecture one is quite qualitative, so a lot of it I did not go line by line. Um, don't worry, if you look through the lecture slides again, you can go through it. Don't worry. So we are not going through 146 slides. So you'll see later what are the things that actually you will have to go through by yourself. Okay. So don't worry, we are not going through 146 slides. A lot of it is actually recap. All right. There's a whole stack of recap slides on time value of money. So don't worry, we'll not go through all that. Okay. We'll cover what is new or so-called important for this module, and the rest are actually more recap, which is important because you need to know them before the next lecture. Right? At the same time, again, I want to address that it's fast because this is more the qualitative side. A lot of things you can read through, like for example, the Potter's Five. So I'm just going back to the Potter's Five. We did not go through every single line in the Potter's Five because it is a framework and there's actually a lot of details here that really is for you to read through and see whether it's kind of useful, right? So there are a lot of details in terms of slides because remember the whole structure of this course is to teach you how to value the company, and what we're trying to teach you are various tools, right? So that and these tools can be very extensive, like the Porter's Five. There's a lot of details, but the thing is you need to use your discretion to say, okay, yes, there's so much things that talk about for Porter's Five, but what are the things that I want to really focus on? Maybe the product differentiation, maybe about more of the industry regulations and this kind of thing, right? So you really need to use your discretion to kind of find out what you want to use in the tools that will help you enhance your valuation at the end of the day. Okay. Uh, All right. So we just talked at PESTEL. So in terms of PESTEL analysis, it's actually just one slide here. Now, the PESTEL analysis, right? It's a bit more general. I say because Porter's Five is quite talking about the competitive advantage is very I would say very finance, very market based. Like you talk about competition in the market, etc. All the various kind of entrance to bargaining power, new entrants. These are very competitive kind of factors, right? The pestle analysis, on the other hand, is very social, more economic kind of analysis, right? What is the economy like? So P is political situation. What is the economic situation? So it's very more general kind of analysis, right? So this framework really is just for you to to remind yourself that, okay, did I discuss a bit on the factors affecting like things like population growth, right? Let's say if I'm talking about, so this is a very interesting one, alcohol. So if I'm talking about alcohol, right, um, we know that, or maybe something that you did not think about is how population growth rate is going to impact alcohol. So the pestle analysis, right, supposed to help you stimulate certain kind of thought process. So why I like to use example of alcohol is this. Many people do not realize how population growth rate is actually impacting alcohol. And the reason why Korea and Japan is going extinct. What does okay? Not sure what that means, but the reason why population growth rate affecting alcohol is because with the lower population growth rate, there's less young people, and generally, right, if you are not in if you are not in a religion that prohibits you to drink alcohol, generally as a youth you can't consume certain amount of alcohol, right? At least taste it or something. Or even if you are uh, 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 kind of restricted for drinking, sometimes as a adolescent, you are more rebellious, you might even do it, right? And therefore, the rate of population growth is actually impacting consumption rate of alcohol. And given that, I like the comment on lower the birth rate below one, given that birth rate is so low, coupled with an aging population, as people age, they drink less. Has a double whammy effect on the alcohol industry. So I hope you can see that with this pestle analysis, right, it has helped me kind of like think about, hey, you know what? Maybe population growth rate is going to affect my industry, my alcohol industry company that I'm trying to invest in or I'm trying to make a valuation on, right? So alcohol, so then becomes an important discussion, right? So I need to focus a lot of my economic analysis on the social aspect of population growth and how this affect my future forecasted cash flow for whatever alcohol company you're trying to value. Let's just say. Uncle Kid sovereign, yeah. Okay, so but then let's see. Okay, so you have a good comment, right? Oh, but people are still drinking beer. Okay, so of course alcohol is such a big one, big umbrella, right? You have beer, you have hard liquor, you have wine. So you need to, of course, see what the what company are valuing and what kind of products they are selling, right? And then we go back now. Then when you think about products they are selling, then you go back to your Porter's Five, right? Are their products differentiated? Are they on a cost, low cost product producer kind of business, which is generally the beer business, low cost, very cheap, right? Compared to more differentiated products, right? Your artisan, I don't know, kind of whiskey or something, right? Your maybe I don't know, Japanese whiskey or Korean whiskey or something like that, right? So it goes back to, it links back to your Porter's Five, and that's where you need to start discussing a Porter's Five. Right. So what I'm trying to bring forward here is that I hope you can see the usefulness of such frameworks as tools to help you analyze the qualitative components of your equity valuation report. Okay, this is a good question. Is it advisable to use both? Now, the thing is, it really depends on how deep you want to go. Okay, on the pestle analysis, right? One important thing I want to highlight is that you need not use every single like alphabets, right? Even though it's recommended, but you need not use every single alphabets because sometimes if you focus so much on the analysis of the general environment using pestle and maybe even portals, you kind of neglect the more important aspect of trying to analyze the company itself. Right. So the thing about pestle is that is about the environment, right? So you're not really analyzing so much on the particular one company, but you try and analyze environment, right? And even before the pestle and the portal, remember we already talked about quite a bit of things, right? When we talk about the industry cycle, we talk about the economic environment, right? Things like the government policy. So we have mentioned a lot of things. So you got to be very careful at the same time, use your absolute discretion to determine what is actually needed, what framework to use. Okay, so for the Porter's five, right? Generally, how it's being used is usually for all five forces is being described, right? For the pestle, normally, okay, so it's very good to use all the alphabets of pestle as well. But I noticed that it becomes very laborious to go through every single PESTEL. And sometimes certain companies, um, it's a bit difficult to think about, like let's say alcohol industry, right? About the T and the E, right? Weather and technology, yeah, maybe there's a bit of like impact, but then if you just write something out for the sake of covering the T and the E for alcohol, sometimes it doesn't make so much sense. So what I notice is that sometimes the pest analysis can be still done very well without using the full range of PESTEL. That's what I noticed. But for the porters, somehow you can actually bring in all the various forces in your argument to support why you are trying to value this company, right? So I hope that provides some clarification. And then next framework we're going to talk about is also the SWOT analysis. So sometimes people don't even use the pestle, maybe they don't even use the porters. In fact, in industry practice, right? So let's say you are an equity analyst or you are a credit analyst, like what I was doing previously. We always use this as SWOT analysis because the industry has no time, or the industry practitioners will have no time to go through five items or the pestle. Pestle is how many items? Let's see how many items we have. One, two, three, four, six items in pestle. They don't have time to go through so many things. So it becomes a simpler framework to just use the SWOT analysis. Okay, just a SWOT analysis. And that's possible too. If you feel that it's a bit okay, maybe for academic exercise, you shouldn't be, I would say, more lesser fair, try to do the least, do the framework with the least option. You should, of course, do the one that has the most value for you in terms of learning. So, but for whatever reason, if you think the SWOT analysis is good enough, then it's good enough, right? If you can come up with an analysis that is deep, that is compelling, then is as good as can get, right? So do not feel that SWOT analysis only for means it's not good. In fact, actually in industry, majority of the people use the SWOT analysis for their company analysis. So these are some of the comments you can consider in the SWOT. So generally, strengths and weakness are internal, opportunities and threats are more external based, right? External factors that's impacting your company. So the SWOT analysis incorporate both the portals and the I would say the pestle, because you're considering both the internal environment, which is here, internal environment, and the external environment here, opportunities and threats that is affecting your company. Okay, which is see competitors, coverage, this kind of thing. So it combines both of it. Yeah, you can use either one of it for your analysis, or you can use two of it, or yeah, one of it, two of it, or all of it if you if you feel that it's necessary. But I just want to highlight to you, choosing two frameworks doesn't mean it's better than choosing just one framework. It's really about how you engage with the framework and how you justify. So, okay, Now, maybe let's take a step back before we continue. Let's try and think about this. Whenever we do the qualitative component of our report, right, of our valuation report, which you eventually write for one of your assessment, whenever you do the qualitative component, so this is a very important part. Whenever you do qualitative component of your valuation report, what you are trying to do is that your qualitative component supposed to eventually link up your quantitative component of your valuation, meaning your discounted cash flow, and eventually link up to your recommendation. Can you see there must be a link? So it cannot be let's say you do your SWOT analysis. You say, wow, this company is so terrible, there's no opportunities, full of threats, but then you still want to do a quantitative valuation, and then in the end you say, I want to recommend you to buy this company. This doesn't link up, right? I mean, this is a very extreme case, of course, right? But I hope you can see that there must be some link, right? If you say that there is certain, let's say a SWOT analysis, let's say there is certain strengths within the company, right? Okay, yes, there's certain strengths. Does this translate to the cash flow? There must be a link, right? So, okay, there's some strengths in terms of, let's say, it has a high bargaining power of the supplier, not of the supplier, sorry. That means so let's say the customer have low bargaining power, meaning that they can charge very high margins or gross profit margins, right? So this is one of the internal strengths of the company. So this must translate to the, of course, high cash flow that is seen in the model they have chosen, right? Your quantitative model. And therefore, because of this is one of your key factor that is driving your recommendation at the end of the day. So there must be some link. So it cannot be, yes, you just talk about environment, whatever, but there's no link to how you get the numbers eventually. Yeah. And okay, that's a good point. In your in your valuation, you can also recommend a sell. Okay, need not always be a buy. It can be a sell recommendation as well. So in case you found a company and you feel that it's good to short sell it, you can actually recommend a short sell as well. Of course, uh, so this is more of a industry thing. Usually, equity analysts tend not to recommend a sell position because they are usually treated less favorable than a analyst that recommends a buy position, right? This is just a market trend, a market, statistical trend that you notice. But you can, of course, do a short sell position, a short recommendation. All right. Okay, company analysis. Okay, this is in fact one of the biggest component for your qualitative part. So I'm going to put 3 stars here. Why? So those who are from accounting background, maybe this will be your forte. So if you do have accounting member in your group, that will be extremely important. Why? Because the company analysis gives you a very good backbone in terms of understanding how the company is doing, and from there be able to do the next step, which is the quantitative component of forecasting the cash flow. If you do not understand the company's financials, you know, how profitable they are, what's the cash flow like, whether are there any liquidity issues, and if you do not engage with this ratio analysis, then you're going to have quite a big difficulty justifying why you say the cash flow in the next 4 years supposed to increase by 10 million, right? It's very hard to justify without some numerical kind of ratio analysis to support your forecast of your cash flow. So this component, I would say, is very important in terms of your um, qualitative analysis, right? So I think most of you have taken the FIN 203. So FIN 203 will have went to much detail in terms of the type of ratios, how do you talk about them, and these are the things that you need to use, okay, to discuss. So while this does show you the ratios, I like your comment. This gives you what to analyze. What to analyze. Okay, so we have seen the financial statement. There's so many things in financial statement. So what do you do? So first you need to compare the P&L and balance sheet items and determine the reason for change, right? What is changing? Why is it changing? And when we think about reason for change, this is where we need to link it back to your industry and economic reasons, right? I hope you can see the link now. Maybe even link to, let's say, Porter's five, right? Porter's five. Kind of link it, or maybe when you talk about industry, is this a growth industry, right? So you need to link it back to there. And then, focus on items with large changes, right? So, for example, in terms of balance sheet, look at the line items in the balance sheet or the profit and loss statement, which one has the largest change or constitute a largest percentage of the balance sheet. Those are the one that you should talk about, right? If it's something that's very small, maybe they have some small little associate company that's giving them some dividends, then maybe nothing to talk about. Yes, they get some dividends for associate, but not interesting. Talk about things that is very interesting because it constitutes a large percentage. Okay, then you cannot just look at 1 year's financial statement. You need to look at the ratio across time. So generally, you need to look at 3 years financial statement, 3 years of financial statement. So how is the ratio changing across time, right? Is it changing? First of all, is the ratio changing because of idiosyncratic factor? I hope you remember what idiosyncratic means. That is something that's uh, 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 that's within the firm, or is it an industry-wide change? Yeah, company specific. You're right. So you're going to see the trend over time and think about it. Whether is it idiosyncratic or is it industry-wide? Take into account industry impact, any kind of economic impact, political impact. So like things like the tariffs, right? So at the same time, let's say if you want to talk about tariffs, right? Let's say, oh, I mean now it's the big news, Trump is imposing tariffs on, let's say, Mexico and Canada, right? So for Canadian companies or Mexican companies, especially in the automotive industry, for sure they'll be affected. But please be very careful. Okay, I repeat again, please be very careful. Now, let's place it on the timeline. Let's put on the timeline here. Okay, so chances are when you're going to analyze a company, chances are you are going to analyze the 2023 financials. Even though now, where are we now? We are now in 2025, but the 2024 financials are unlikely to be available yet. This is not available, right? Because it's too early, right? You haven't get the audited financials out. So chances are you're still going to analyze the 2023 financials. So whenever we think about this economic impact, you need to think about it at year 2023. So please be very careful. If you are talking about current situation, right? Please make sure that the situation you are trying to describe is the situation in the year that the financial statement is being written for. If it's a 2023 financial audited financial statement, it must be a factor that is in 2023, not what's happening now. So the Trump tariff, you cannot talk about it in your description for your company analysis. Does that make sense? Is everyone clear? This is important because I've seen equity report that try to talk about very recent developments, but then they are talking about it. They're analyzing a 2022 financials. Then there is no link. There is immediately, unfortunately, a red flag. It's not correct already. Okay, so okay, so uh, yeah, so analyzing a company, I hope you can now see that you really need to pull in a lot of your knowledge from everywhere, not only in finance, in accounting, in more social science aspect of economics, industry, etc. Right? And also be very careful in terms of what dates you're talking about. Okay. Um, there is usually a management analysis, right? Written for public companies. Please also be very careful for management analysis because management typically would not shoot themselves on their foot. What does this mean? It means that they will not, even though the economy is so bad, the company is doing so badly, they will spin it such that it's okay, right? It's not so bad. Maybe they don't say it's amazing, but they say it's not so bad, all right? But as a equity analyst, you are a third party. You're not the company, right? You are going to recommend this company for investment to your investor. So it's imperative that you make sure you are stating facts as it is. So you're not the company, so you do not need to be biased, right? If the company is doing bad, just say it's doing bad, right? So while the company management analysis is a good benchmark, please do not wholesale just take the analysis and just paste it in your answer. Yes, maybe you believe that's true, but most of the time a good equity analyst would know that the management analysis is always biased. And if your recommendation is the same as the management analysis, then you are a very bad equity analyst because you have no value added, right? No one's going to pay you, I don't know, 150K per year or more to write something that the company already wrote, right? You need to be, they call it a contrarian, right? You need to write something that is different. You need to write something that is interesting so that investors will like, oh, okay, this is interesting. I never thought of it this way, right? Okay, so I'm going to invest it because of this. Great. Yes. Oh, I really like that question. That's a good point. Wouldn't recent events affect estimates and projections? So you are right. So when we are doing company analysis, we are doing historical, right? Historical based on the FS, financial statements. Now, when you're doing your projections, which is where you need to provide assumptions, why do you project a 10% growth? They need some assumptions. Yes, then your recent events will be perfect to support your projections. That's a good question. So, but in a company analysis, we are looking at historical. Journalists. Okay. Uh, all right. So bring and last but not last but not least, but then you have to bring in context as well in terms of the reason for change of the ratio, right? So for example, is the population declining such that there's less volume of purchase of, let's say, alcohol, and therefore there is a decrease in net profit margin, or not net profit, decrease net profit, right? So you have to bring context, right? What's the reason behind the decrease in net profit? Let's just say. Okay. So when I talk about the decrease in purchase of alcohol because of declining population, this brings in the industry analysis already, right? So you need to bring some industry analysis. Um, Please comment on one of exceptional items and black swan events. So, you know, I think the whole idea of what is it? The impact on the airline industry from COVID has been over talked about. Everyone knows the impact on airline industry, but there is also an impact on the supply chain. So not many people think about the supply chain issue. So in fact, even till today, a lot of the companies that rely on supply chain, for example, things like okay, it's not very fancy, but it's things like grain. Okay, yeah, iPhone, okay, at that point of time. But even now, if you think about things like grain, paper, okay, they are not fancy products, like grain. Who is interested in grain, right? Your rice, your barley. But if you are interested in this kind of more agricultural products, you'll notice that the supply chain impact of on grains uh, um, can even be felt as late as 2023. Okay, so why I even mention this? Because recently I've been doing an analysis on a grain company, and this is something that I noticed. It was very interesting because in 2023, the impact of COVID would have been more or less, you would think that it's not even impacting those companies, right? Wherever you think about COVID, it's always like air travel, entertainment industry. But in fact, the grain industry was impacted up to 2023 because of the supply chain shortage, which has caused a build up, first of all, or not really build up, a build in demand, less of supply, right? Meaning prices appreciated, went up, and then when COVID ended, supply increased in order to meet the demand, but the demand is pent-up demand, right? So the pent-up demand is still driving prices up to 2023, where it actually peaked. So what happens to the grain price? The grain price, right? It has been like going normal, like fluctuating here and there, and then it has plateaued and then increased due to COVID, keep on increasing even after COVID, and then only peaked at 2023, which is actually just 2 years ago. It peaked at 2023 here, and then at 2024, because now the demand has been met, but the production keep on staying so high, and then it start dropping. So in 2024, it actually has started falling. The price has fallen because supply has continued to be high due to the initial high pent-up demand. But now the pent-up demand has all been met. So the demand went back to normal levels. And because the supply is so high now, the prices are dropping. So, when we think about black swan event, so why am I talking about grains all of a sudden? So the idea is that when we talk about black swan event, we have to think deeply in terms of how it actually affects a company, right? Yeah, okay, get short now because the demand is not required, right? So so just be very careful. When we think about black swan events, we might think easily about the basic stuff, right? Air travel, entertainment, but it can actually affect multiple types of industry. Okay. Last but not least, please think about things like impairment write-off. Whenever we see impairment write-off, those are very important to consider. Need to understand why the impairment is happening. Is it because of poor investment decisions resulting in impairment of certain products? Then we need to be very careful already. Then please analyze it, right? Yes. So, okay. So that's a good question. Economic and industry analysis should be recent. Um, yes, it should be recent because it will support your projections, but it also can link to a bit of the past as well, because it can you can use your economic and industry analysis to support your company analysis. So it goes both way, right? It can be forward-looking for economic and industry, and it can be also a bit of historical. So it can be both. Yes. So you can actually make historical performance analysis based on the financials, and then you can have a forward-looking statement. So, for example, you say that the growth of the bottom line has peaked. Let's say we're talking about a grain company that I was talking about, right? Has peaked at 2023 because of supply chain, blah blah blah, and because of that, there is an oversupply, and in the coming years, it's expected to decrease, I don't know, by 5% year on year. So there is a forward-looking statement of that. Yes, you can do that. Okay. this is just a summary. Um, Okay, so I think this is, let me just quickly check. Okay, so before we just go into just touch very briefly on technical analysis, I just want to pause here, right? Because I know there's a lot of information. And the thing about lecture one is it's important to the extent that it generally encompasses around 30 to 35% of the report's grades because it's the qualitative part of your report. So I just want to pause here. Do we have any questions? I do see very good questions that we have tried to answer along the way, but maybe we just pause for a short while and see any other questions. This is a good summary page as well. So what's the uh so so this is the first lecture. So let me find out more details. In fact, I do not. I know it's lecture one, lecture two. It will be tested on lecture one, lecture two. But in terms of the format, the how they're going to test it, let me get back to you. I know that it will be a mixture of MCQ and short answer kind of questions. So it'll be both. Yeah, but I believe the school also will, yeah, an open book. Yeah, the open book part, it was announced. Yeah. Racial essays have no. Okay. Why no valuation ratios, right? Let me see. Yes, you're right. Is this intentional? Yes, so this intentional. Why no valuation ratios? Is because the valuation ratios will be covered under the I think lecture four or lecture five. Basically, yeah, I think lecture five. Basically, what I mean is that there is a whole section just on using ratios for valuation, and these are valuation ratios. So we will compare your valuation ratios with industry averages. So there's a proper way to use the valuation ratios to value the company, like your PE ratio, your PS ratio. So those are there's a technique to use it. So we're going to understand in depth how to use those ratios. So that's why in your ratio analysis, in for your company analysis component of your valuation report, there is no valuation ratios. It's intentional. So I hope you can appreciate now, at least in this summary page, right? When we do, at least at the qualitative level of the equity analysis, we need to really consider many factors, right? Which is why, at the start of today's lecture, I mentioned that, equity analyst, it's a job that it has both a art and a science to it, right? Because there's so many things to consider, there's so many frameworks, it's possible to do everything, right? You cannot do Potters, Pastel, and SWOT, right? Yes, maybe you can, but then there's no value, right? There's just so much information, right? So there's a large component as an art form, right? Where you need to have your discretion to say, okay, what's important for me? What's important in this valuation report that I need to put there that the investors need to read about, right? There's a large component as an art to doing valuation, and that's why the top and then analysts, equity analysts actually they are paid a lot to just make a recommendation whether it's a buy, sell, or hold recommendation. And I hope you can see that it is because there's just so much information that you need to consider, so much factors, whether it's political, economic, fiscal, monetary policies that you need to really consider before even finally making a recommendation of a buy, hold, or sell. Okay, so last part on technical analysis, I'm not going to go through it in detail at all. Basically, I just want to mention that to let you understand what is technical analysis, and basically it's the idea of using charts, right? So like bar charts, candlestick charts to plot some lines, and by plotting these lines, you try to determine certain patterns, right? Certain patterns that allow you to determine what is the pattern in the future. So the underlying assumption here is, of course, the pattern in the past will replicate itself in the future, right? That is the assumption that you need to have when doing technical analysis. If you do not believe in the pattern at all, then don't bother using it, right? And this, of course, more trading kind of patterns. So you can see here, we are looking at some patterns that's going up, up, up. You know, these are the trend lines. So, you know, you say like, oh, okay, if I'm at this point here, means that it's likely going up, right? Of course, there are some micro patterns. Can you see it go down? So these are some micro patterns or called secondary patterns that are happening, or even tertiary patterns. But the primary trend is on upwards trend. Okay. So this is just some description you can read about it. We will go into a lot of detail in our technical analysis lecture. So just some, let's put some information here. So we'll go into details. Okay. So do not need to worry about this. Okay. Now we are at slide 72. So like I mentioned, we are not going to go through all 149 slides. So if you notice, right, if you're going to compare my deck of slides with the deck of slides from other classes, I usually like to have quite a lot more slides. And the reason why is that usually I add a lot more information to the extent that you do not need to refer to a textbook. So the slides are usually good enough. But not only that, you know, like at this point in the lecture, whatever that is after this is actually just I just plot important information from your other lectures that you need to know before we go on to lecture 2. Okay? So this idea of time value of money, in case you are a bit rusty, I have put the basic, you know, this is your level 1 time value of money. So explaining to you what is time value of money, what is compounding, you know, very basic. So in case you need a recap, please go through by yourself. Next week there's no lecture, so please use the time to go through this. What is present value, what's future value? Because next week we are going to cover the overview of the quantitative methods for valuation. So if I'll say lecture 1 and lecture 2 will be foundational for the entire course, because we're going to cover, of course, lecture 1 is all your qualitative, and lecture 2 is all your quantitative, but not in much detail. And then the lecture um, 3, 4, and 5 will be in detail of the quantitative methods, right? But lecture 2 gives you all the quantitative tools that you need to use, but in not so much detail. And when we talk about quantitative tools, meaning that we need to have a good understanding of time value of money really. So we'll definitely not have time to explain to you what is present value, you know, what is a growing annuity. So you need to know what's growing annuity. We'll not have time to explain to you, you know, cash flow, you know, these kind of things. Discount rate, what is discount rate? What's the perpetuity? So it's important. You need to be able to understand perpetuity. What's a growing perpetuity? So all these are, you know, kind of actually repeat of your level 1 modules. So I've just put all this here for you. Annuity due, you need to know what's that. So annuity due. So in case you do not remember, please go through that. Okay. And then I even added some self-review examples. So these are questions to just kind of allow you to practice in terms of time value of money, right? So in case you are very familiar with time value of money, you can totally skip this. You don't even need to bother about this part of the slides. I'll pause here. Any questions regarding how we actually how I've structured these slides and what to do for let's say next week if you have some time. So there's quite a lot of questions actually. So let's see. I don't know. Okay, so there is one last part for next week for your own self-review is this uh self-review example, valuation example. You can focus mostly on how they actually write the qualitative component that if you can see, things like overview, what some recent developments, competitive strengths, some risks, you can have a look at it like what is being written. It's actually quite old. It's FY16, so it's a bit old. You can look at things like the business and all this. So these are generally like some stuff that usually written. Um, these are some social factors that's going to impact the industry, things like that. Um, Really just for you to, that quarters five, how does it structure affect the company? So these are just a good example for you to kind of see how the frameworks are being used for valuation. Okay. Let me just pause the recording. We are done. Let's see.